welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight. And today's show, we're talking about what is a good cash flow today, in today's market. Now, look, interest rates have been rising. That has hurt property investors' cash flows. At the same time, we've seen property prices come down. So what does a cash flow look like for a property in today's market? Andrew, kick us off with the first one.
So let's talk about when you bought the property. So cash flow depends a little bit on if you bought the property today or whether or not you bought it, like in some cases with some of my investors, a couple of years ago, and we've been waiting for that build to complete. And so there's been some upward pressure on rates, but also on rent. So I've got an investor that bought a house in Wellington about 2 years ago. Purchase price was $525,000.
What would it be worth today?
It would easily be worth $825,000 now. And the rent when we first looked at that property was $525 a week rent. Now it's about $630 a week. So since they signed up for that property, they've made $300K in equity and another $105 a week in rent. But remember, interest rates have gone up. So let's compare the cash flows.
So what we're going to do is I'm going to pull up my cash flow spreadsheet, the Opus Return on Investment Calculator, with the assumptions that we had at the time that this person bought their investment property. In fact, they would have bought it before we even invented this. And then let's look at it based on today's assumed interest rate. So Andrew, what are we seeing here for everybody on YouTube? And describe it for everybody listening to the audio version of the podcast.
Yeah, so when they bought it, the interest rates were about 3%. Eventually going up to 4.5%. So the outlook back then was that interest rates would stay low for a longer period of time than they have.
Do you remember when we were all saying that?
Everyone.
Those were the days.
Yeah, those were the days when economists could say whatever they wanted. Now, the worst cash flow year was less than $100 a week, and that was in year 4. The total contributions over the 15-year period was $17,500, so an average of $42 a week.
So over the 8 years of the investor first owning this property with 100% borrowing, they'd have to put in $42 a week on average, and all up it would be negatively geared by $17,500.
Yep.
Okay, so what happened to interest rates and what are we looking at today? And then we'll look at the cash flow.
Well, interest rates now, as we know, 6% for a year, and we go to 6.25% next year before dropping back to some of the more likely long-term averages of gain of that 4.5-year interest rate. And our outlook now is that interest rates are going to stay high for a couple of years before they start dropping back. Now, the cash flow now is really interesting. So the property is negatively geared for the next 3 years. So less time, but more expensive. So
now, why is that though?
We're working on a much higher interest rate now, but the same long-term interest rate. And of course, we've had that extra $105 a week coming in rent.
Yeah, the massive increase in rent has meant that the total period that the property is negatively geared has decreased, even though interest rates have increased quite a bit. Now, did you say what the total top-up was?
No, so it's $153 a week on average, but it's the most expensive for the first 2 years, where it hovers just over $200 a week.
So if you compare the two scenarios, though, scenario one with the low interest rates and lower rent for that property, $17,500 was what the investor would have to put in over the 8 years. Now it's gone up to $24,000, so increased by good old $6,500. But it's in that smaller period. Now, bear in mind, of course, they've already made $300,000, so that investment's worked out for them.
Well, that's what I was going to say. I mean, it's another $6,500 worth of money that they're going to have to top up, but they've started out with a $300K runway. Not bad.
Now, the most important thing that I just want to mention is we showed you this one first. If you'd signed up for a property perhaps a couple of years ago and you're thinking, well, what's the cash flow going to be now? Now I want to talk about something that you might buy today at today's market. Now, this one, actually, Andrew, you tell us about this one. We're calling it Marcroft, but where is it and what is this sort of property?
So this is a standard 2-bedroom townhouse in Christchurch, relatively central area called Wellington, and it's your double story, 2 bedrooms, 1.5 bathroom with a car park.
Your classic 2-bed townhouse in Christchurch. Now, I do want to talk about what this would have looked like previously, but let's look at it based on today's assumption. So the purchase price on this is $559,000, so $559K, and it's got a rent for about $480 a week. I think that's pretty conservative. Now, what you can see is that the cash flow in year 2, because we're assuming that this property might take 12 months to be built, But once you settle that property, the cash flow is terrible. The worst cash flow year is negative about $360 to $380 per week. And what's that there, Andrew? About $16,000 in the red in the first year of operating. Then it goes down to about $200 a week and down and so on and so forth, but eventually becoming cash flow positive in year 12. And that averages out at about $115 a week to hold this property over that period. But bear in mind, for the first 5 years of operating, or at least the first 4 years of operating, it's a bit higher than that while the interest rates are higher.
Yeah, but see, one of the advantages of something like this, which is 12 months away from completing, is you only need to pay the interest on your deposit for that first period of time. So if you were diligent enough to save $200 a week, say, for example, for year one, you're only actually going to use about $3,000-$4,000 of that. So you're actually going to have enough money in your account. So next year when you're $16,000, it's still just that $200 a week contribution.
And of course, last Monday, the whole podcast and episode was about, well, how do you manage this? But it's worth pointing out that even though the average for a property might be $150 a week, you've still got to weather the storm, if we can call it that, where you might have a higher top-up of over $300 a week. Now, a fair question to ask that many property investors out there are thinking is, well, why would I buy an investment property if I've got to top it up by $300, perhaps if it was a more expensive property, $400 a week, in some instances, even a little bit higher. So walk us through the difference between buying this property now compared to if you'd bought it, say, 12 months ago.
So I think the thing to remember is that there's always market factors working for and against you. And I've said this time and time again. So right now we have high interest rates and we have a more challenging lending market, but we've got great deals. So let's just look at this property again, for example. If you bought this property a year ago in the peak of the market, you probably would have paid $650,000. So
really?
Yeah, easily. And so you basically would have paid $91,000 more than what you would if you bought it today.
It's really interesting. I remember sitting there probably November last year, and you couldn't get a townhouse in Christchurch for less than $650. Two-bed townhouse.
Yeah, absolutely.
$650 would be the bottom of the market.
And so before, you would have bought it and it would have been 3.5% going up to 5%, and that's on a $650 purchase price. Same rent and cost structure. But today, you've got the higher interest rate, 6%, and then 6.25 next year, but then them dropping back to a lower amount faster. So from a cash flow perspective, anyone on YouTube now will be able to see Ed looking at basically a cash flow forecast where your worst year is still better than the worst year on the higher interest rates.
Or it's about the same.
But it's negatively geared for a much longer period of time. If we flip over to the cash flow now, you'll see that by year 12, it's positively geared.
Well, one of the things we should look at as well that we haven't looked at is what is the total amount of money you'd have to put in for that. So if we look at what you'd have to put in currently over that 15-year period, you'd have to put in a total of $65,000 at today's interest rates. Now, if you'd purchased that property at the higher price, but with a lower interest rate outlook, let's just go and see what that would look like as well. You would have had to put in $125K, even at lower interest rates, but the higher purchase price.
And bear in mind that $65,000, there were also $10,000 coming in positive years in that 15-year outlook as well. So while this is a net 125, the other is a net 55.
And I think this is the thing that property investors probably just need to be aware of, that price difference, that drop of, we're talking about $91,000 in this case, where this property would have been significantly more expensive, is that even though the worst cash flow year has been brought forward, i.e. you buy it and it's year 2, actually the overall picture is improved. And it's not until you start running it, these calculations based on, well, what were our interest rate predictions 12 months ago and how does that compare to today, that you start to think, actually, perhaps it's not as bad as you initially think with all of the media headlines. Bear in mind that the media headlines in November last year was buy now, it's a great time to buy. And of course, at that time, it really did feel like a good time to buy. Now, let's look at one more property. And I'll tell you a little secret. Probably, was it 2 weeks ago, we held a little secret private webinar.
Joy and Manuel were very upset about this because they saw it on my story on Instagram and they realised that there was a webinar that they didn't know about.
Oh, we kept that one on the download, but this was just for all of the investors that Andrew had been working with for a long, long time. And we invited them to a private webinar to talk about some of the deals that we see coming up. And just briefly talk us about Remu Street in Wellington, what these are before, just while I'm getting up the cash flow.
Sure. So these are 2-bedroom townhouses by a reputable builder in Lower Hutt in Wellington. So it's really interesting because I've been probably pretty cold on Wellington for the last 5, 6, 7 years. But now that prices have come back a bit, all of a sudden the yields are looking pretty attractive. And while I don't think you're going to see any significant growth in Wellington for the next few years, I do think it's one that should be on our radar at the right price. If it's the right deal and you're looking for growth, you've got to be looking at this for a 15-year period. But at the right price, it might be quite good because what you're finding is the rents have stayed strong, but of course the prices have come down drastically. So I'll give you an example. So for Remu Street, the cash flow is $113 a week on average for 5 years. But then it's positively geared. So you just have to get through this initial hump of high interest rates. Year one, of course, remember, is just your deposit. So it's less than $5,000, less than $100 a week. The worst year is year two, $15,000, so $300 a week. But again, you could smooth out those contributions. And then when you get to year three, you're back down to around about $100 a week.
Yeah, but what's really important for property investors to be aware of if they are buying property is it's not just about the average. There are definitely ways to smooth it out, and that's what last week's episode was all about. But you need to be aware that you are going to have this year of terrible cash flow.
Yep.
And you've got to be aware of why you're going to accept that if you are going to invest. And the reason is because the prices come back. Now, let me ask you this. If you were evaluating this property 12 months ago at the height of the market or just before that, this property is currently being listed for $650,000. What would it have been priced at a year ago?
I think quite comfortably it could be $800,000. I've seen one of the large developers of New Zealand advertising townhouses in not as nice an area for over $800,000, I think $850,000.
So let's assume the 800K.
Yep.
So the reason you'd buy this is because the property price compared to what it would have been a year ago is down, let's call it $150,000.
That's right.
That's why you're willing to invest or sacrifice 10% of that to get that property at that relatively cheaper price.
That's right.
Because here's the thing, most people out there are not listening to this show. Most people out there who would go out and push the price of properties up and clamber into the market, they're going to be thinking, well, why would I invest at 6.25%? Well, because the property prices come down, it has come down 150K, you've got to invest 10% of that, $15,000. You're probably going to have to put in some top up anyway. And so as long as you can use some of those strategies we talked about in order to weather that cash flow, it certainly can be the right time to buy for some investors.
Well, put it this way. If I told you, Ed, give me $15,000, I'll give you back $150,000, would you do that deal?
Well, bear in mind, it's not exactly like that, is it?
No, I know.
Because,
but when you're thinking long term, you know, those prices will come back.
Those prices will eventually come back, but it's about getting in today. I just don't want people to say, oh, well, it's worth $800K and I'm only paying $650. No, in today's market, it's probably worth $650. But you're going in because you know that as those interest rates come back eventually, as we expect them to do, as inflation is tamed, that's where you're going to see the benefit of it. Right, let's wrap it up there. But please don't forget to rate, review, and subscribe to the Property Academy podcast. Really helps us get the message out to more people. And hey, I want to see you at our webinar tomorrow night. That is Tuesday, the 8th of November at 7 p.m. You're going to get our predictions for both interest rates and house prices for 2023. Links down in the description and the show notes, so tap or swipe over the cover art, links in there, or just go to opuspartners.co.nz. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight. I'm going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most of using the property market. Until next time.